Hi everyone, this is Bank Talk with Ethan and Van. And I'd like to thank you all for joining us today. Van, we had a great June. A couple of great meetings here, dinners that we had, one in Chicago, one in Minneapolis. Definitely different kind of groups of people, but since, this is the first one you've done with me, I'm kind of curious to get your own sense. What was the biggest surprise? What did you hear in these two events that really surprised you?
Well, you're right, Ethan. It was very interesting discussions in both places, in part because we had a whole variety of perspectives. I'd say that a couple of takeaways stuck with me. One, that no one really seems to be too concerned about economic fundamentals, right? Even though there are plenty of things to worry about. If I were to tick off a handful of these, we're in the second longest economic expansion on record, now into our 10th year. There are plenty of geopolitical issues still out there, not just North Korea, but Italy, the strong dollar impacting emerging markets, potential trade war, et cetera. Credit spreads are out at 16-month wides, right? 16-month wides in credit spreads. And of course, the yield curve is flattening and is threatening to go inverted. So there's all sorts of things that should be on people's radars that I think a lot of us in the markets these days seem to be discounting. I guess our attendees are basking in the glow of an economy in great shape, to quote our new Fed chairman, a banking system where all tested firms passed for the fourth year in a row. And I guess that's why the broad consensus among our attendees is that the Fed will tighten 3 or 4 more times. A second takeaway I had is that pressure on deposits has become very real, and in some instances, banks are pulling back on loan originations as a result.
Did you find that surprising? Like that, we heard that from one of the home loans that attended our event, and I thought that was, he mentioned a couple of key markets. I think Vegas was one of them that banks have pulled back on.
Yep, Pacific Northwest, another. I agree. I thought this was quite surprising because the macro and the micro data we see suggests that there is still plenty of capacity in the system to step in and lend. In fact, in your most recent Bank Treasury newsletter, you point out that the banking system's loan-to-deposit ratio is still a very reasonable 84%. And so maybe this is just a reminder that banking is a local business and could be prone to regional or SMSA pressures.
Right. Well, we are seeing, there was an interesting article in the journal, I think, over the weekend, or one of the journal publications, that was talking about how bigger banks are starting to pay bounties for deposits, which I thought was pretty amazing, considering if they are swimming in deposits in a macro sense. But again, like you just said, I think it's the fact that on an individual basis, there are institutions that are feeling some pressure on deposits. And again, I think that the bigger concern is when rates do turn, there's going to be a point, there is an inflection point. Every bank I've spoken to talks about this, that they expect deposit rates to then start to catch up. Do you think that's true?
I think that's right. We've gotten used to very little competition in deposit markets now for years, and there's always a change. The cycle will always change. We're clearly in that kind of an environment now. The large banks clearly have the technology and the marketing budgets to go out and chase deposits here, and they've clearly pushed up. We see ads in the paper all the time for the cost of money on deposit products going up. How impactful this will be remains to be seen. We always remind credit investors that we focus not just on deposit betas, but also asset betas, right? So for an industry that is notoriously asset sensitive, rising rates, provided it's gradual, should still be a positive thing.
Right. So it was interesting to me, just to recap, so you said it's almost a universal view that everything is benign.
Correct.
Second was these concerns around deposit funding. But I was surprised to hear these expectations around 2020, that there was going to be finally something, that people were pretty much in agreement, or at least I heard that in Chicago.
2020 being when we might see a turn
in recession.
Right.
Some kind of a recession.
Yeah, I mean, the data out there, it's just survey data, right, generally says that recession likelihood in the next year is 5% or lower. And even 3 years out, 2/3 generally of people believe that we will still be in expansion. Then we're obviously on the longest economic expansion on record. Who knows, right? There generally has to be a catalyst of some sort that presents itself. So we'll continue to sort of look through what that might be. But for now, it looks like it's clear sailing, or at least the broad consensus out there is that from a fundamental perspective in both the economy and the banking system is smooth sailing.
So Van, the only reason I'm asking you this is since you sit at the top of the ratings process here for corporates, how does that knowledge that 2020 could be the point in the recession? I know rating agencies rate through a cycle, but boy, wouldn't it be you must be a little bit more concerned when you're at that tail ends of a cycle than in other points when you put up a rating.
Well, I think anybody looking at markets today has to be concerned because this is truly uncharted waters, right? The degree to which central banks have participated in this recovery is unprecedented. You have just massive flows that are in play, and how this all plays out remains to be seen. And again, we'll always sort of look for the catalyst that's going to trigger change. What we know is that corporate leverage is at an all-time high. So let me stop there, Ethan, and ask you about what's next. What does the after show look like from your perspective?
I'm glad you asked, the after show. So this month's after show, I'm going to focus on highly volatile commercial real estate. So, Basel III, under the U.S. Basel III rules, applied a 150% risk weight to commercial real estate called highly volatile commercial real estate. That became, and since that rule came into it, I guess the law was Basel III came into effect, I think in 2014, when it did, or 2013, when the rule went into effect. There was a lot of confusion. There has been a lot of confusion on how to apply that definition. Regulators came in last year with a new definition called highly volatile acquisition, development, and construction loans, which became a little bit easier. Now S2 155 steps in again, try to make this a little bit simpler. And I guess the context to that is, as a rating agency, obviously commercial real estate in the financial space has always been one of those big concerns. And, to the degree that there's some sort of a scaling back or loosening of regulations, that certainly has to raise the rating agency antennas. I think what this actually will do, and I think that's what I want to talk about, is it actually makes it a more efficient rule. And actually, even though you're rolling back a rule, you're actually making it a better rule by doing that. So that's what we'll talk about.
Yeah, no, I think, and just to follow up, there's no single bigger issue that we focus on in commercial real estate across the whole banking system, from community banks, regional banks, the very large banks. Whenever you've had very low interest rates for a protracted period of time, real estate developers will develop. There has to be some excess there that will all come out in the next downturn. We'll try and get ahead of it. And to your point, regulators have been ahead of it, imposing rules which hopefully will act as a more effective, in this cycle, a more effective governor of capital that has flowed into commercial real estate. But it certainly is a topic that we will continue to watch very closely.
Okay, well, that's it for us today. Thank you for listening to us, everybody. We'll be back next month. And of course, look for our Bank Talk, the after show. Thank you.
Thank you.